Hi everyone, welcome to Business Education and Research. The company's financial condition is measured in terms of long-term financial ability and short-term financial ability. The short-term financial ability is evaluated in terms of liquid ratios, namely the current ratio and quick ratio. The current ratio is an important ratio which measures the short-term financial position of a company. The current ratio is widely adopted by financial analysts and stock market analysts to test the financial condition of the company, particularly the short-term position. The current ratio measures the proportion of the current assets of the company to its total current liabilities. The current ratio indicates how many times the current assets are equal to the current liability. The current ratio reflects the short-term financial condition of the company. The current ratio measures the proportion of the company's current assets to its current liabilities. The current assets are the assets that can be converted into cash within a period of 1 year. The current liabilities are the short-term obligations of the company that are to be settled within a period of 1 year. Now let us see the examples of current assets. The stock of raw materials, work in progress, and finished goods, sundry debtors and accounts receivables, bills receivables, cash and bank balance are coming under the category of current assets. So these assets can be converted into cash within a period of 1 year. Now let us see the examples of current liabilities. Sundry creditors, interest payable, outstanding wages and salaries, accounts payable, bills payable are the few examples of current liabilities. These liabilities are to be settled by company within a period of 1 year. The company's ideal current ratio is always compared with industry's average. For example, the industry's current ratio average is 1.8. If the particular company's current ratio is 1.75 or 1.8, it is almost equal to its industry's average. So it is good one. In case if the company's current ratio is just 1, whereas industry average is 1.8, it indicates the company's poor financial condition, particularly short-term position, because the current ratio of the company is just 1 when compared to industry's average of 1.8. At the same time, having excess amount of current ratio is also not a good situation. For example, if the company's current ratio is 2.8, whereas industry average is just 1.8, this situation is also not good because the excess amount of current ratio indicates abnormal investment in current assets, which is going to result in a lot of idle current assets, and it will pull down the return on investments. So therefore, the company should have a level of current ratio which is almost equivalent to its industry's average. To know the real financial condition of the company, interpretation of current ratio is very important. When current ratio is 1, it indicates the current assets are equal to its current liabilities. It is balanced 1. When current ratio is more than 1, it means the current assets are more than its current liabilities. It indicates a better short-term financial condition of the company. But when the current ratio is less than 1, it means the current liabilities are more than its current assets. It means the short-term obligation of the company is very high when compared to its short-term assets. So the repayment ability is very less here. When current ratio is more than 1, it means the current assets are more than its current liability. It's a good condition. Current assets are more than current liability is a good condition. Whereas when current ratio is higher than 2, for example, the current assets are 2 whereas current liabilities are 1. That is a situation of current ratio of 2. It means the company has more current assets than current liability. The company can easily repay its short-term obligation. the short-term financial condition, short-term liquidity of the condition is very high. But at the same time, it indicates the excess amount of investment in current assets than its actual requirements. The company has abnormal amount of surplus current assets than actually it is required. Therefore, it is going to pull down the overall return on investments. So, the current ratio of the company is mostly decided and influenced by the credit terms and conditions, credit period, and collection efficiency of the company. So the overall collection efficiency of the company really influences the real quality of current assets ratio. For example, if the accounts receivables are not collected on time, then the cash inflow cannot match its cash outflows. Now let us see the two companies with same level of current ratio, company X and company Y. Both companies' current ratio are at the same level. That is 2 here, here also 2. The current ratio is same because the proportion of current assets to current liability of these two companies are at the same level. But when you see the elements of current assets, you can see cash and bank balance of X is 100,000, whereas Y is just 50,000. But accounts receivable of X is 20,000, whereas Y is 70,000. So the cash and bank balance is already within the hands of the company. The company can draw the money from bank at any time or use the existing cash balance at any time to meet its short-term obligations. In that case, company X is in a better position because it has high level of highly liquid current assets, 100,000 here, whereas Y is just 50,000. The second element of current assets of these two companies are accounts receivable, meaning the money to be collected from its customers. When companies sell goods on credit basis, accounts receivables results in. So the money to be collected from the customer is 70,000 for Y, whereas X is just 20,000. So the conversion of the accounts receivables into cash is in the hands of the collection department. If collection machinery is very sound, this can be collected within the set time without any problem. Otherwise, if the collection department is not efficient, if there is any delay in collection due to any other reasons, then the real amount of current assets will be affected. So therefore, the conversion level of these current assets into cash on set time within the specific time is the real determining factor. So therefore, the current ratio of X is 2 like Y, but whereas the real short-term liquidity condition of the company X is better than Y because company X has more liquid assets than Y. The current ratio is widely used by financial analysts and stock market analysts to know the real financial condition, particularly the short-term position of the company. However, current ratio has its own limitations. The current ratio fails when you find it difficult to compare between two companies due to company's size, nature of the industry, or any other acceptable reasons. Lack of specificity is another area where the current ratio fails. The ability of the company to convert its current assets into cash mainly determined by quality of current ratio and efficiency of collection management of the company. This slide shows the current ratio calculation for Oil and Natural Gas Commission Limited for a consolidated value rupees in crores for a period of 5 years from 2018 to 2022. The various elements of current assets, namely inventories, trade receivables, cash and equivalents, short-term loans and advances, and other current assets are presented here. Similarly, when you see the current liabilities, short-term borrowings, trade payables, other current liabilities, short-term provisions are given as various current liabilities and total is given here. So the current assets divided by current liability, you get current ratio. So the calculated current ratio for the period 2018, 19, 20, 21, 22 are presented here. If you see the current assets of the company, there is a consistent increase from 2018, March 2018, it is consistently increasing over a period of 5 years. But when you see the current ratio, it is highly fluctuating. Let us see the level of current liabilities during this period. Current liabilities is also increasing, right? See, for example, in 2018, the current assets of the company increased from 48,000 to 51,874. But current ratio has come down. Why? Because the increase in current liabilities is very high when compared to increase in current assets. So both current assets and current liabilities are increasing during these two periods. But the percentage of increase of current assets is less when compared to the percentage of increase in current liabilities. That's why the current ratio has come down from 1 to 0.66. In the next year, 2020, there is an increase of current assets from 51,000 to 65,000. So higher amount of increase. Whereas current liabilities of the company have come down from 78,000 to 67,000. So current assets increased, current assets reduced. That's why the current ratio increased from 0.66 to 0.98. So if you see the current assets and current liabilities and its proportion, the growth of current assets and current liabilities when compared to previous periods will give you the more information for understanding why the current ratio is increasing or decreasing. When you see the overall current ratio of ONGC, it is just around 1, and in fact less than 1 in March 2022. So therefore, the short-term liquidity condition of the company is not very high. So the company has to focus on improving the amount of current assets and reducing its short-term obligations. At the same time, they have to focus on the increasing the quality of current assets by increasing the efficiency of collection management.